Good afternoon, everybody, and welcome to this edition of our Think Learning webinar series. Today, we'll be looking at 3 small cap stocks to watch out for in 2021. My name is Carl Capelingua. I'm the market analyst over here at Think Markets, and it is a pleasure to be with you. Now, before we go through the content of today's presentation, let's talk about the Think Markets difference, which is substantial. $8 flat rate trades, your own holder identification number, unlimited phone support, and of course no hidden platform or subscription fees. 4 fantastic reasons to make sure your next ASX share trade is with Think Markets. The agenda for today, as I said, we're going to look at some smaller capitalisation stocks, try and kick over a few rocks and find the gold out there in the proverbial stock market desert. The stocks we're looking at today: AVA Risk Group, ticker code AVA, that's got a market capitalisation of around about 51 million. Australian Vintage, ticker code AVG, market cap around 160, a little bit bigger. And then Hubify, which is ticker code HFY with a market cap of around 50 million. Before we talk about those 3 fantastic stocks, we're going to talk about our selection process. How did we select them? And we'll kick off with our overriding philosophy, and that is this idea of finding growth at a reasonable price. So first and foremost, we want a stock whose earnings are growing. It's not only is it profitable, I guess, but those profits are increasing over time. Certainly the market pays a premium for stocks with high growth. Secondly, is the business able to fund its growth organically? So this is a funny way of saying, is it cash flow positive? Do we have more cash coming in from its day-to-day businesses than going out, and then therefore that cash can be used to grow the business further, potentially to pay down debts, to pay dividends, etc. And does the share price reflect reasonable value? So once we've considered the first 2 criteria, are we still seeing good value in the current share price? A stock who has fantastic growth, who's able to fund its business organically, but is extremely expensive, is obviously not something as attractive to us compared to a stock who has those first 2 criteria and of course is still relatively cheap in our opinion on the market. Next, we want to understand from looking at the chart whether the market is seeing the same things we're seeing. So we might look at a company and think it's absolutely fantastic, tick, tick, tick on the 3 previous financial and valuation criteria, but it's in a spiralling downtrend. And that would indicate that whilst there may well be these fantastic things going on in the company, the market isn't yet seeing that. The risk is that if we buy now, we could see the price much, much cheaper down the track, and that would be disappointing for us. Even if it did, rally a year from now and get us back to break even, we potentially could have had a much better entry point. So we're going to look at that chart and look for signs where the trends, that is the price movement in general over a period of time, whether the trends are matching what we're seeing in the fundamentals. So we should see a period in the short term and in the long term of share price appreciation to tell us that, well, think about it, share price appreciation can only come from one thing, and that is demand is greater than supply. Is the price near an opportune entry point as well? So within those trends, we might be pulling back to a support level where we can get in at a small discount to the overall trend. Okay, so the first company we're going to talk about today is AVA Risk Group, ticker code AVA, and this is a stock in the information technology sector. As we said before, stock market capitalisation of around about $50 million. Now, your bigger capitalisation stocks in your ASX top 20, they are in the many, many billions of dollars, just to put it into perspective. So these are very, very small companies, relatively speaking, but that doesn't mean that just because they're small, they don't have fantastic management teams behind them, fantastic businesses, and businesses that are growing really, really well also. So this one is in a very one of my favourite sectors, I should say, at the moment, which is security, but it's more broad than just saying perhaps cybersecurity, preventing online cyber attacks and things like that. We're actually managing the security of assets. So we can see at the first point, the intrusion detection and location for perimeters, pipelines and data networks. So if you're an oil and gas company and you want to make sure that your pipeline is intact and it's functioning properly, you're going to have potentially thousands of sensors along that pipeline, and AVA, supply and then monitor those sensors. Biometrics, card access control and locking. So, very important these days to identify who people are and if they're in the right place at the right time. And then I've got the third part of the business there, which is the ability to transport things of value around the place in a safe and secure way. And apart from that, more general risk consultancy services around technology and personnel and asset risk management. Here are the various divisions of the company. Three main divisions split into mainly technology and services. So FFT stands for Future Fibre Technologies, which was actually the previous name of the company. You can see it's through various acquisitions. It's expanded its business over time to become AVA Risk Group. So that is your perimeter monitoring, pipeline, interference, conveyor monitoring, so even conveyor belts at minerals companies as well. And then you've got your BQT Solutions, which does your biometric entry access, and then your AVA Global Logistics, which of course does transporting goods of value safely and securely. FFT is the biggest by far and away EBITDA contributor, so that's its operating profit because it tends to be less capital intensive. You can imagine the company like AVA Global transporting things of value from place to place. You need the assets and the personnel to do that, so that is the biggest revenue by segment, but it's not as profitable as FFT. Nonetheless, look, three really fascinating and very efficient businesses in their own right combined into this umbrella of AVA Risk Group. In terms of the financials, we can see that the company has steadily grown its revenues over the last 1, 2, 3, 4 years, and it has been making losses for the 3 of those 4 years, but made its maiden profit last year, and the growth rate there is ticking along very nicely, so we're expecting those profits to continue. In terms of the dividends, profits have continued, and in fact cash flows have continued so well that the company actually has paid a couple of dividends so far this financial year, one in October of 1 cent and one just paid literally when ex-dividend on the 9th of Feb for 2 cents. So when you consider the stocks trading around 60 cents, 3 cents per annum give or take of dividends puts it on a pretty nice yield, as we'll see on the next slide. Just looking at sort of recent performance for company information the company's giving us. They just released their first half update for FY21, so that's the period to the end of December 31. We saw a 70% increase in sales revenue, a massive increase in EBITDA. Free cash flows up as well, so really showing the business is humming along nicely. Management is getting as much out of the business as possible. All business units were profitable. Gross margins actually increased by 7% to 34%, which is an amazing performance. When you see those sorts of metrics, gross margins, you can tell you've got good management. We've got $13.4 million in the bank, which facilitated the paying of that 2 cents per share special dividend. New revenue streams coming online in the second half, and increasing existing revenue streams as well. The company said, quote unquote, the outlook remains strong and there are additional revenue opportunities to capture for the second half. Just looking a little bit further back to the FY20 results, that saw a 46% increase in sales revenue, and it was, as I said before, their maiden NPAT of about 4.9 million, but also maiden cash flow positive years and EBITDA as well. So this is where I'd like to jump on to businesses. They are not deep in that research and development phase or that marketing phase where they're burning cash to try and make more cash. The cash is coming in, and they're rolling with some momentum. And having a look at the valuation metrics for AVA, and these are my FY21 estimates. It's trading on a current enterprise value to revenue of 1.83. And that, if you compare it to the stocks in the All Ordinaries Index, about the top 500 ASX stocks, it puts it in sort of the top 26% or ahead of 74% of the companies. And looking at its price to earnings ratio of about 8.6 times, is very low, puts it sort of in the top 5% of companies there. Its PEG, so that is the value of the company compared to how fast its earnings are growing, 0.06. Now, typically anything less than 1 is considered to be good at 0.06. It's very, very good indeed. Price to free cash flows of 8.1, still very good. return on equity is amazing. Very, very few companies in the market could boast a return of equity of 61%, and its dividend yield, whilst unfranked, is still putting it in the top 13% of companies, but take into account that that is an unfranked dividend. Looking at its average rank, it gets a score of 86%, which puts it in the top 3% of companies, as I said, in the All Ordinaries Index. Many of those companies, many billions of dollars. You don't have to pay billions of dollars in market cap to get a company that is ticking all the right boxes. Having a look at whether the market agrees with our assessment of AVA. Certainly they did through the back half of 2020. It saw a tremendous increase in its price from about 15 cents to about 76 cents. And it was just the market realising how good this thing is. Now, the great news for us is it has pulled back a third to a half of the way, and it's bounced off a long-term area of support, which we're looking at here. That is our long-term dynamic support zone, and starting to head back in the right direction. I think giving us an opportunity to get in well off those highs and still at some great value. So the short-term trend is just about to turn up. It would have turned up if not for that special dividend. So that big dip down yesterday, even though it did rally, was mainly due to the ex-dividend. So there would be more momentum, which would push it into a short-term uptrend. I'm happy to buy it anywhere around these current levels. If you're a little bit more conservative, you might go on a break of 64.5, and that will just confirm our next leg up of positive momentum. So pretty happy with the fundamentals and the technicals for AVA. Next one is Australian Vintage. This one is in the consumer staples sector. The Vintage might give you a bit of a hint as to what it does. Vineyard management. They grow grapes. They turn those grapes into very popular wine, and obviously sales and marketing of that wine around the globe, and bulk processing as well for other vineyards. Have a look at some of the brands. You've probably partaken in consumption of some of these brands. McGuigan Wines, Tempest 2, Nebith, which is, I think, how you say that one, but I honestly haven't tried that one, and a Barossa Valley Wine Company. You can see some of the awards and medals that those wines have won. They're the four pillar brands of the business. They do have some others, but they are the main ones. In terms of the company's financial performance over the last 4 years, we can see some very strong growth in revenues through 17-19. We had a bit of a flat one in 2020, so revenues were down literally by 1%, which was mainly to do with COVID. So I think if you got to the end of financial year 2020 and you said we're going to have a global pandemic and revenues running down 1%, I think you'd take that as a very good performance. Importantly, and this demonstrates management's ability to get the most out of their business, we can see that net profit rose anyway, even though we saw a 1% fall in revenues, and that is super impressive, and they were able to increase their dividends as well. And this one, as we'll see in a little while, has an incredible dividend yield. So that looks fantastic. Let's have a look at some more detail that the company's provided us recently. Well, the most recent one that they've given us is from their AGM presentation back in 25th November 2020, and they talked of continuing revenue increases, very good in the pillar brands, improving free cash flows. They guided the market, and that was also quite rare in 2020 to see guidance either provided or maintained, and very encouragingly, we're looking at an increase of 34.5% free cash flow for FY21, a decrease of 26% in debt, and increase in operational efficiency, and that's measured by return on capital employed, ROCE, of 47%. All very impressive in their FY20 results. As we said, revenues were down 1%, but management still managed to increase net profit after tax by 35%, as was earnings per share increased by that amount. The Australian new car sales remain robust, and that's despite the impacts of COVID in the UK. Earlier in the year, the more broadly, actually, the Australian Vintage was severely impacted by drought, floods, fires, you name it. Everything hit the more broader Vintage in Australia, and what that has led to is a decline in supply for Australian wine in the 2020 Vintage. Now, fortunately, AVG was able to dodge much of that and actually increased their yields. So they're in this great position where supply is lower. More broadly speaking, prices have gone up as a result, and they've still got plenty to sell into the market. And we've seen 3 out of 4 of their brands grew by over 10%, but growth in all of 4 of those brands. And you're probably already asking the question in your mind, what about China? We know that the Chinese government has unofficially slapped a tariff on Australian wines. Treasury Wine Estate, the big Australian wine producer, they have a huge proportion of their sales heading into China. They've been significantly adversely impacted, and their share price has basically halved over the last 12 months. Well, these guys, they sell mainly through Australia, Asia, ex-China, into the US and the UK and Europe, and China sells only 2%, so they don't expect any impact at all from any continuing trade tensions between China and Australia. That's encouraging, de-risks the company significantly. Of course, there are risks involved in an agricultural company. The next fire, the next flood, the next drought could be around the corner. But taking all of those things into account, the management seemed very adept at managing all of these potentialities. And before I talk about the valuation metrics here, I should mention we have done another webinar in our Think Learning series, which is titled How to Value a Stock, and I encourage you to go to the website and search for that, which explains how to calculate and then interpret most of those metrics on the screen. In fact, all of them except for return on equity and dividend yield. Now, we all know what the dividend yield is. Return on equity, a little bit more tricky to calculate, and that's why I've deliberately left it out of that webinar. But the rest of those, EV to R, PER, PEG, and P to FCF are all explained in detail in that webinar. So I encourage you to go there and learn about how to calculate and interpret these. But these are the numbers we have for Australian vintage, 0.95 for its EV to revenue, which is a fantastic number there. We can see better than 80% of the stocks in the All Ordinaries Index. It's PER better than 94%, PEG better than 89%, price to cash flow better than 68%. Return on equity, if that was one chink in the armour here, it would be that one, but it's the nature of the business. So if you compare this to other agricultural businesses, which, let's face it, are quite capital intensive, you would expect to see a return on equity around that much. So I'm not too fazed by that at all, and the dividend yield certainly makes up for it, although it's only 63% franked. It is a tremendous yield at 8.5%. And when you look at a great dividend, you've got to ask yourself, look, is that likely to be sustainable? I can't see anything in the financials that would suggest that it's not going to be. Its average rank is 77%, so looking at those factors and a number of other factors that we look at here, which puts it in the top 7% of companies on the All Ordinaries Index. As I said, with a market cap of around about 150 odd million, you don't have to pay billions to get a fantastic company. Does the rest of the market agree with our assessment of Australian vintage? Well, generally speaking, yes, they do. So we do see that the company is in a long-term uptrend, as evidenced by our longer-term moving averages, the dark green zone. It's in a bit of a neutral trend in the short term at the moment, and it is consolidating a rather sharp increase recently there. So that's in November, and I'd say that would be probably around the time that it updated the market during that AGM, and investors really just cottoning on to how well this one is doing. We're not paying the highest prices. We're getting a little bit of a pullback here, and it is in quite a nice support zone around 56.5 to sort of 60 cents, and I'd be happy to buy anywhere in that zone. If you're a little bit more conservative, you could go on a break of, say, 60.25, which would mean buying at 60.5 cents or higher. But otherwise, with some very nice trends, very much that bottom left to top right look on the chart. I can't see anything in the technicals that wouldn't suggest that those fundamentals are very much intact and in play. The third and final stock for our look at our small caps today is Hubify, and very interesting little telecommunications company. The name suggests they're trying to put all of those things that you might need in terms of telecommunications, IT, hardware, put that all together for your small to medium enterprise. And that's certainly the market segment they're targeting for, as it says there, their main business, managed IT, cloud services, including cybersecurity, and accompanying hardware sales, so selling the gear and then looking after that gear for you. Voice and data mobility, so they are a telecommunication company as well, and then the Internet of Things, very catchy phrase at the moment. So enabling devices to talk to each other over the internet and provide us with valuable data and information. Very, very rapidly growing area of the technology market at the moment. And lastly, look, this is not really part of the business, but it's what they do really well, and they've been doing it really since they listed, and that is acquiring businesses that do any of those things, and some things that maybe don't do those things but are very complementary, buying them very cheaply and then integrating them into the business to continue to grow profits. And this is just a breakdown of, I guess, of the three main pillars that they're targeting. So those managed services, telecommunications and Internet of Things, and the revenue breakdown. You can see most of the revenue really coming from that telecommunications aspect of the business, but the global IoT is a rapidly growing part of the business as well. Have a look at the financials for the company. We can see, apart from a little bit of a dip from 17 to 18, certainly the last 3 years we've seen some fantastic growth in revenues, and we're tracking very well. We should be probably, it's going to be close to 19 million in revenues this year based upon the guidance that we'll see on the next page. And this is what I like to see. We are moving into the profit column after some losses, and that should, I think, based upon their performance, continue to grow. No dividends at the moment. Looking at the recent updates from the company, we'd see on 15th December 2020, they gave us some insight to how their H1 FY21 was going. At the time, they were seeing a 20% increase in revenue over the H2 FY20, but way up from the PCP, which stands for previous corresponding period. Sorry for using all the acronyms here. We saw a 62% increase in EBITDA as well, which is earnings before interest, tax, depreciation, amortization on PCP. Annualized recurring revenue, ARR, up 50%. So this is the revenue that they're getting from subscriptions. So it's really great revenue for a business to have. They don't have to go out there and hunt down new contracts. This is revenue coming from existing clients. It's great to see such a strong performance there. Fourth consecutive cash flow positive quarter in that September quarter, and that should continue through to the most recent December quarter. And that's allowing them to continue to grow their bank balance, now 6.6 million in the bank. And that's a really important number, because we talked previously about the fact that Hubify hasn't yet paid a dividend. But as that cash keeps growing, that possibility becomes increasingly more likely. Yes, it is a business that is still investing heavily in the business to grow the business, so they will be at that tipping point, I believe, in the not too distant future, where they can divert some of that cash away from growth into dividends. This is a copy and paste from the AVA one, but it is absolutely what the company stated. They do have new revenue streams coming on in the next half, and increasing existing revenue streams as well. FY20 results, I'm just throwing that in there just to show some of the great growth that they're achieving. And that's really what we're after in these small cap stocks. And it was their second year as NPAT positive, very encouraging. Have a look at some of the valuation metrics. We've got an EV to R of 2.35, a PER of 8.6, PE growth ratio. Remember, we want something underneath 1 there at 0.43. It is fantastic. Price to free cash flows, 36.2. That's a little bit lower than a couple of the other ones that we've seen. But again, we've discussed this idea that they're diverting some of those cash flows into growth, and that will change over time. But we are cash flow positive, and that is a key factor for me in selecting any stock. Return on equity is amazing at 43%. It's better than 97% of the stocks in the All Ords. It doesn't have a dividend yield yet, but maybe not in the not too distant future. And it gives it an average rank of 68%, which is lower than the first two we've seen, but is still better than 81% of stocks in the All Ordinaries Index. Now, again, those All Ords, some of the biggest stocks, most well-known stocks on the market, with caps of billions of dollars. We don't have to go there if we want some great growth and a really well-run company. Okay, does the market agree with our assessment of Hubify? Well, it certainly looks like it does. We've got a long-term trend in place, as evidenced by our long-term moving averages, the dark green zone. The short-term trend has just turned up, as we've seen a little bit of a pop more recently. I haven't seen any news to explain that pop. It could well be anticipation of the December quarter results coming out. But nonetheless, it's encouraging to see that demand clearly is greater than supply, both in the short term and the long term. And that can only occur on the demand side if people really like the stock, and on the supply side, equally so, they don't want to sell it. I'd be happy to buy around the current levels. I don't think you need to wait for a pullback into sort of that 9.5, 10. If you did get it, I certainly think that's great value down there. So technicals look good, fundamentals look good. That's our third stock for the day. Just to recap, AVA Risk Group, ticker code AVA. Australian Vintage, ticker code AVG, and that last one, Hubify, HFY. We've got plenty more news, research, and other market updates available in our market news section of the website. There's the link. You can follow me, all the Think Markets handles on Twitter. We'll have more Think Learning events for you to take part in. Next week, I'll be doing the Ask the Experts session where you get to tune in and ask me about your portfolio. Bring your portfolio along and I'll give you a fundamental and technical on the stocks that you're interested in. You do need to register for these, by the way, and head to the website, the webinar section, and find those. And then we'll have a look on the 24th of Feb at 3 stocks with dividend and growth. I've really found 2 of them, haven't you? So I'm going to have to dig up another 3 for you to look at. And then 10th of March, we'll do the how to create an investing plan, and that would be after the Ask the Experts on the 3rd. The disclaimer before I leave you says that everything we've discussed today is general in nature. We are a regulated Australian broker. We do have some products that could see you lose more than your deposits. Please, if you've got any questions, give us a call or consult the website for further details. It has been a pleasure being with you today. Hopefully you got lots out of it. All the best for your trading. Until we catch up again. Bye-bye for now.